Today we're going to be talking about the Magnificent Seven. Now I'm not talking about the 1960s classic or the remake made in 2016. I'm talking about today's top 7 companies. Everybody's seen them, everybody's heard about them, they're all over the news. The term is Magnificent Seven and they seem to be becoming a larger and larger part of people's portfolios and people's attention. I'm going to discuss what exactly makes the Magnificent Seven magnificent, if at all, and how should long-term investors think about these as companies and then as stocks for their long-term portfolio. And so why are we talking about the Magnificent Seven specifically? Well, the reason is when you look at the market today, there's really 2 stock markets. There's the Magnificent Seven, and then there's every other market in the world. Now, why am I saying that? Well, the reason I'm saying that is this chart here. So let's look at this chart, which shows the price to earnings ratios of the Magnificent Seven and then of every other market in the world, all the way from, Europe over on the right, US small and middle-sized companies, emerging markets, and then all the way over here where you have the S&P 500 minus the Magnificent Seven. And what do you notice? What you'll notice is outside of the Magnificent Seven, you have the whole world trading between 10 and 15 times price to earnings, which means for every dollar in earnings, people are willing to pay between $10 and $15, which is about average. And so what does that mean? It doesn't mean there's any wild deals. It doesn't mean anything is incredibly expensive. This is just normal. And then we look at the Magnificent Seven, which currently is trading at about 40 times price to earnings. So depending on what you're comparing it to, it could be anywhere between over 2 times or 3 times the rest of the world. And so when we're looking at our portfolio, what do we really own here? Do we own the rest of the world, or are we owning this Magnificent Seven story? Now, why might we own the Magnificent Seven story? Well, why would a company trade at these really high price to earnings? In other words, why are people paying more for these companies relative to the rest of the world? Well, and a lot of the story seems to be, well, these companies are going to grow faster. Well, let's dig into that with a little bit of data. So this chart here is looking at the top 130 companies based on their earnings per share growth. So how quickly are these companies growing their earnings? And what you can see is there's a big, the number one is 300% growth, which is very high. And then all the way you scroll down to the bottom and it's 25% plus earnings growth, which is all very good. There are many companies that are not growing nearly 25%. But of the top 300 companies, you think, okay, the Magnificent Seven, these are quickly growing companies. That's why they're so expensive, right, Kyle? Well, where do the Magnificent Seven companies land on this chart? How quickly is the Magnificent Seven growing its earnings? Well, if you go all the way to the right, close to the back, there is only one company in the Magnificent Seven that is on this chart at all. So said another way, of the top 130 companies that are growing their earnings all the way from 25 to 300%, only one Magnificent Seven company is on this list. So what does that tell us? It tells us that people are willing to pay more for these companies, maybe thinking their earnings are going to be growing faster than others. But what is the reality? The reality of it is these are well-known companies, right? Tesla, people know the cars. Apple, people know the phones. Nvidia, people are talking about artificial intelligence. These are well-known products and solutions, but the actual companies are not growing at nearly the rate that many people are assuming and are paying for in their portfolio. And so why are we talking about this? Well, the reason that we're talking about this is when you think about your portfolio, sometimes successful investing is not about figuring out what do we need to invest in. So in looking at, going back to the other chart, when we see, okay, we've got your S&P 500 stocks, we've got your small cap, you have emerging markets, you got all these, the rest of the world essentially, that's trading between 10, 14 times earnings, so about average. And so what are we talking about here? We're not necessarily saying which of these should you be over allocating towards. Rather, is there anything that maybe you should try and avoid? And what I would look at as a long-term investor, seeing over this on the left, where you see people that are paying a very large amount of money for these investments, is sometimes it's not about picking which one to invest in over on the right, maybe just diversify, but what can you avoid? Because when you pay a high price for an asset or you pay a high price for future cash flows, your expected rate of return is lower. It's okay. Sometimes it's just about what to avoid. You might say, well, Kyle, I don't know. The Magnificent Seven, people have been talking about it. It's been doing great. I still want it in my portfolio, or maybe I want it in my portfolio. Tell me a little more. Okay, I'm going to tell you a little bit more. So let's look at this chart here. So this is going back, and it's categorizing investments by theme over the last 70 years. So going back all the way to the 50s, this is saying, okay, what are the investment themes based on what people are talking about, what the media is talking about, that has done really well over these investment decades? And you've got the European stocks, the Nifty 50, which are the 50 largest US companies. We've got emerging markets, Japanese stocks, American tech, we all remember that. And then emerging markets again, and today we have these mega caps, or the Magnificent Seven. And what is the challenge of becoming a theme on this chart? Well, if you go back, and I'm going to save you a whole lot of time going through the numbers, but every single one of these themes, after they became a theme, had a chronic period of underperformance. Now, why is that? Does it mean that the stocks in these themes are bad? No, it doesn't mean that at all. Some of these are great stocks. But what happens with these themes, they get a lot of attention, and people are willing to pay for these companies at any price, irrespective of their earnings or irrespective of the fundamentals. And what happens is people start paying too much for future cash flows or for a stock, which means your future return goes down. This happens over and over again. So the great news is this should not come as a surprise if we see in the future that these high-tech growth companies end up not growing so much at all as far as the stock price goes. We have data that shows us, hey, people are paying 2 and 3 times the amount of money for these larger companies that are getting all the attention, and they're paying a higher multiple for these companies, and the larger companies aren't growing as fast as many people think. And we have 70 years worth of data that shows us when these larger themes become themes, in other words, when they've done so well for long enough that people start paying attention, what happens next? And what happens next is underperformance. Not because the companies or the investment idea is bad, but because people are paying too much. And so when you look at your portfolio, sometimes it's as important or more important to figure out, what am I not going to invest in as much as what you are going to invest in? I hope you found this helpful, and as always, thanks for investing your time with the Personal CFO.